You should not be trying to invest like Warren Buffett. In today's video, we are going to build a stock scanner that returns to you the actual right kind of stocks you need to be buying to make money in today's market environment. Yes, he was able to turn a couple $1,000s into over 100 billion, but you won't be able to do that utilizing his same strategies for a few reasons. Let's take a closer look at when he actually made most of his money. Very early days, 14, 15 years old. He's making a few $1,000s a year, fine and dandy. When he hits this 26 years old here, he makes a jump in 4 years from 26,000 up to $1,000,000. Now, I believe there was like some sort of loan from his grandfather or something that happened in that period that like really kickstarted his compounding interest journey. And if that is true, I think that's sort of a rumor I heard. If that's true, that's reason number one why you're not going to do a Warren Buffett. Unless you have a $1,000,000 inheritance coming in sometime soon, you're just not going to get started on your compounding interest with that much money. But also, more importantly for this segment of the video, pay attention now from 30 years old to 33 years old. He more than doubles his money in 3 years. Then by the time he's 35, so in 5 years, he's gone from $1,000,000 to $7,000,000. Those are absolutely insane returns. And keep in mind, this was 60 years ago. You know, he's 90 plus years old now. This was 60 years ago he was making these kind of returns. And you get sort of a similar story up here when you're looking at even ages like at 47, he was worth 67 million. Then 4 years later at 52, he's 376 million. That is a 5x on your portfolio in 4 years. Ridiculous. And once again, this is 50, 55 years ago. This is a long time ago Warren Buffett was doing that. And actually, if you look up sort of to the more recent decades, he goes from 17 billion to 36 billion in 6 years. That's a little over a double in 6 years. Then in 11 years, he once again, actually, he doesn't even quite double in 11 years. He goes from 36 bill to 58 bill. Then over the last 9 years, not even quite double either, from 58 to 109. Those are actually like relatively average returns considering what the market has done over the last 30 years. Doubling your portfolio every 9, 10, 11 years is actually not like insane. It just looks insane on this graph because of the power of compounding interest. But Warren Buffett really hammered the markets 50 years ago, 60 years ago. That's when he was absolutely crushing, and he's just obviously been smart enough and understands compounding interest to leave his money in the market. So now even with more average returns, he's making billions and billions of dollars every year. Value investing nowadays just is a completely different ball game versus what it was in Buffett's prime. The markets were just way less efficient, meaning you could actually go out, read the right papers, read the right annual filings, and you could actually find stocks that were very obviously extremely undervalued. Whereas today, with all the algorithms and automated trading technologies, etc., that's really not happening as much. And even Warren Buffett admitted himself multiple times that he couldn't replicate his early successes if he were starting out today with the same tools and knowledge. So then, are you screwed? Is it now impossible to make money picking stocks in the stock market? No, absolutely not. Something somebody told me when I was very young in my life is that basically everything is like a pendulum. If we have too large of a move in one direction, it will overcorrect and swing in the other direction. So as where 40, 50, 60 years ago, value investing was very easy because of the lack of technology and just the gaps in the market efficiency, nowadays growth investing is much easier. You see, whereas within value investing, you are searching for undervalued stocks to buy and then obviously have the valuation eventually catch up before you attempt to sell. With growth investing, you are looking for stocks that are already experiencing a large jump in revenue and you are expecting that revenue growth to continue. So you can sort of think of it as value investing is more like a reversal investing strategy. You're looking for weak stocks on the way down, whereas growth investing is you are looking for a continuation trading strategy. You are looking to buy high, sell higher. I want to talk about the macro trends page for stock ticker symbol DSGX. Scroll down, what we are looking at here is the price to earnings ratio overlaid with the EPS and the stock price. This is what I'm talking about when I'm talking about growth stocks versus value stocks. A value investor would typically be looking for a very low price to earnings ratio, meaning the ticker is trading at a smaller ratio than the earnings the company is actually bringing in, whereas a growth investor will be looking for a high PE ratio. That is to assume that the market is pricing in high future growth for this company. This is a stock, once again, DSGX, that comes right off the scanner we are about to build. And as you can see, in like 2014, this thing jumped up to a PE ratio of hundreds, and even in the 80s, it sort of settled down in the mid 60s to low 70s here through 2015, 2016. That is an extremely high price to earnings ratio. But look, the stock price at the same moment was, $15, $16, $17, $20. And since then, the earnings per share has exploded. The stock has exploded to up over $100 a share. So seeing the high price to earnings ratio on this thing 5-6 years ago, or oh my God, I thought 2015 was 5-6 years ago. Oh no, 10 years ago, seeing the high price, that just made me feel old. Sorry. What am I talking about? Seeing the high price to earnings ratio 10 years ago on this thing could have been a signifier when it was trading at $15 that, hey, the market is expecting heavy future growth on this stock, and the market in this case was very correct. Lucky for us, ThinkorSwim has built-in study functions that we can reference within its scanners to help us find stocks currently trading at a high price to earnings ratio. This will help us to identify stocks that the market is pricing in high future growth expectations for. For starters, I have a couple of stock filters turned on. One being don't show me any stock trading less than $5. The second being don't show me any stock that has traded less than 500,000 shares of volume on the day. These are subjective. Feel free to set up your stock filters to align with whatever types of stocks that you like to trade. Now, of course, the meat and potatoes of this scan will be two filters of the fundamental filter type. So I'm going to add a filter, of course, first being fundamental. And the first one I want to add in is earnings per share. And I'm going to say that the 5-year average must be a minimum of 0.01. Just don't show me any stocks that aren't making money, aren't averaging a positive earnings per share over the last 5 years. The second and most important fundamental filter we will add is, of course, the price to earnings ratio. And what I set mine as, well, first off, I also don't go to 5-year average. I go to current on this one. And what I set mine to is that the current price to earnings ratio must be 50 or greater. So we go from the thousands and thousands of stocks that are available to trade in the stock market down to now just a list of 56. But we are not done at all yet with building out this scanner, because just because we now have a list of high price to earnings ratio stocks, we need a way to sort them so that the strongest of them appear at the top of the scan results. To adjust the scan columns that you have on in your results down here at the bottom half of the screen, you can click on the tiny cog icon to the far right of your scan headers, go into customize, and what you think I might be about to turn on here is the price to earnings ratio and sort top down ascending by that. But that is one way you can go about it, but I find that you get a lot of really wonky results when you do that. Like, let me just do it for an example real quick. Let's sort top down ascending by price to earnings. You get some that are sitting at like 4,000. Well, this is an ADR, which isn't representative of the actual company itself. So let's skip that one. But still, this one's got a price to earnings ratio over 1,300. This one's over 400. You get some just kind of ridiculous results at the top of your scanner when you sort just by price to earnings. So rather than that, what I like to sort by is sales per share. Essentially the amount of revenue per share available to trade that the company is bringing in. So when we sort top down by this, we are now seeing stocks that have at least a price to earnings ratio over 50. So they all still have very high price to earnings ratios, but they are sorted top down by the companies that are making the most money. Those are going to be the ones that are the most secure investments alongside their very high growth expectations that the markets are baking into them. So the first stock on our scanner is Costco. So what I will do from here is hop on over to Google. I will type in cost stock PE ratio macro trends. This is how I get to that macro trends page I showed you earlier. And I'll just take a look at what the price to earnings ratio looks like, what the EPS looks like, and of course, what the share price looks like. And something like this is exactly what I want to see. A consistent growth in the earnings per share over time, a nice sort of consistent, even growing price to earnings ratio. This just means that there is validity behind the reason for the company having a very high price to earnings ratio. This is a strong, growing company. It makes sense that the stock market would be giving them a high value. They are a growing company. They are expected to continue growing. And very important to note here, I want you to once again note that in late 2019, just from this example period here, the price to earnings ratio is 32.6. The stock is trading almost 33 times earnings. That is ridiculously high. That is something that a traditional value investor like Warren Buffett would avoid entirely. That is bad value. But a growth investor would look at that and they would see, I mean, you can even see the earnings per share growing up to that point before that. They would see the growth and they would see the vision that the market sees in giving it this high price to earnings ratio. And you could enter that stock at $275. And since then, it has gone up more than 4x. Well, 275 times 4, I think, is more than 1,048. Nearly 4x has the stock gone up since then. I also just realized in saying that, sorry, we should keep it realistic to the scanner that we just built, in which I set the minimum price to earnings ratio to 50. So actually, we wouldn't have seen Costco on the list back here, but Costco does break over 50 PE ratio for the first time here in August of 2024 at $890 a share. Then once again by February of 2025. So just in 4 months from then, from the first time it appears on the scanner, the stock is up over, once again, not over, nearly $200 a share just in, once again, that 4-month span from when it would have first appeared on the scan. The second stock on our scanner is PWR. So back within this macro trends page, we can simply type in PWR here, load up that PE ratio chart, and wow, look at the stock price of this thing first. Look at the nice growing EPS of this company as well. So once again, the stock market giving PWR a high, 30x price to earnings ratio was a correct future growth expectation because the EPS growth did come in. The stock did fly from, less than $90, even back here was $30, up to over $300 a share. The stock did break above 50 EPS for the first time Looks like this is the first time here in March of 2024, goes from $259 a share to December of 2024, $315 a share. Let's look at one more because the third stock on the list is a name we all know and one I'm actually interested to see the chart for, being Spotify. So once again, back within macro trends, let's go to Spotify and let's take a look. Spotify, of course, is on an absolute tear lately. That much I did know, but I haven't looked at their earnings per share. Very notable here is that you'll see that the price to earnings ratio is 0 for a very long time. That's because Spotify wasn't making money. They had a negative EPS. Of course, if there is no earnings, you can't divide by 0. So if there's negative earnings, if there's no positive earnings, then the price to earnings ratio will always be non-existent or 0. The first time that Spotify turns in a positive EPS, at least the first time in a long time, was in June of 2024, and the price to earnings ratio is 127. Ridiculously high. You're telling me this stock is trading 127 times earnings? Value investors would look at that and puke. But if a growth investor looked at that and liked the growth that the market was projecting for this company moving forward, they entered the stock at $313, once again in June of 2024, and in January, February, March, April. In April of 2025, the stock is $574 a share. Oh my gosh, overvalued is what you hear a lot of beginner investors say. Not always. Growth investing is a great way to target very fast moving bullish names. If you are interested in this scanner, it, alongside over 150 other custom coded scanners, studies, even trading strategies, all within ThinkorSwim, are available over on my website, daytradingstrategies.net. Go check it out. Click the sign up button. When you sign up, you get access to all 150 plus codes. It's not like I charge extra for other deluxe codes or anything like that. No, you'll get access to everything. And right now you can choose to either sign up monthly or annually. Of course, if you sign up for the annual plan, obviously you will save money, but even more importantly, you will also get lifetime access to a Discord server full of like-minded people, full of people that have access to all these ThinkorSwim codes, so you can talk about what you find works best for you. I am always adding and updating new codes to the website. That's why I have it set up as a membership. But if you would just like to sign up, download the codes that are available now. You can cancel with just 3 mouse clicks very easily under the My Account tab. I promise you, it's not like some scam try to lock you in, something like that. You can cancel very easily. If you just want to sign up, download some codes and cancel, no skin off my back. I'm very happy to provide that for you. Feel free to do so if that's your plan. Anyway, daytradingstrategies.net. Click the link in the description down below. At least go read the reviews, check it out, decide if it's something that could help accelerate your trading journey. I'll just say quickly too, obviously the title and thumbnail of this video is a little bit tongue-in-cheek. I don't think the guy that has turned thousands of dollars into over $100 billion in revenue, being Warren Buffett, was actually wrong, right? He obviously did the right thing for his time. I just don't think the time for that type of value investing exists anymore, unfortunately. Things are always evolving. You need to keep up with the times rather than trying to learn to invest in such an antiquated way. So if you did enjoy this video, if you learned something about growth investing, please take the half second to hit the like button. If you would like to continue learning, make sure you subscribe to this YouTube channel. Click the red button down below. It's free. Why not do it? With all that being said, I'm going to go ahead and sign out of this video, and I'll catch you all in the next one.